Hello, it's Brian Akers from Akers Financial Group, and welcome you to our market update and review. We're glad to have you here on our video this time. Today, I have myself talking a little bit about Akers Financial Group and some thoughts, and then we'll bring on Alex Monk. Alex Monk will be reviewing the AFG Select Portfolios, our year 2025. And then, of course, we'll have Mark DiOrio from Brookstone Capital Management will be on at the end of the video to go over his market update for 2025, going through all the different pieces of the market and give us great information. So today we have a lot of things to talk about. Akers Financial Group, I was blessed to have you as clients, and we're honored to be able to help you to achieve your goals, to win in retirement throughout all those retirement years. As you know, Akers Financial Group's been around for a while. This year we celebrate our 20th anniversary of Akers Financial Group. That's a wonderful 20th year. Many of you have been clients the whole 20 years and even longer have been clients of mine. I really thank you for that. Our vision for this year is for education to be through our radio shows on WCBM 680 on Saturday and Sunday morning. Also on 105.7 The Fan, 11 a.m. every Saturday morning. And on WBAL, we began sponsoring the closing bell and then having special spots on their news throughout this year. The calendars this year, there's a big event, September 11th. It's a Friday this year. It'd be the 25th year of September 11th. So we're going to have memories of that. But we're also going to use that as what we used to call our training day. We're going to call it the Akers Financial Forum. That Akers Financial Forum will be that afternoon into the night as we try to educate everyone on what's going on in the markets. Last fall in 2025, we videoed the forum portion of our AFG training day. That will be available on our website very soon with all the topics and the videos for those that enjoy educating themselves on what's been going on, especially the one big beautiful bill that came in effect on July 4th of 2025. Now, hopefully you're signed up for our emails. Our emails go out every Wednesday. Kim Haight and her team do a great job of updating everyone on everything that's going on at Akers Financial Group. We have an update on the markets, and we try to tell you things to be thinking about, articles to read so you understand what's going on. And we encourage you to read that each and every week. So the radio shows are 10 a.m. on Saturday at WCBM and 9 a.m. on Sunday at WCBM. And 105.7 The Fan, it's on 11 o'clock on Saturday. You can follow us on Facebook. That's a site we have. It's linked. And you'll see that we've been advertising in the new Harford County City Life magazine. A friend of mine started that magazine, and we've been supporting that. So that's another way of getting to know us. And they have a lot of information tied to our Facebook page. If you ever have any questions on events or what's going on at Akers Financial Group, we have our website under events. We also have an email, events@akersfinancial.com. You can reach Kim Haight. Kim Haight is always available to help you guys understand all that's out there. So when we're talking about the finances, financial planning, and the year 2026, my advice to everyone is this: understand your personal situation and help us be your financial advisor. We need to know where things are. We call that your financial fingerprint. That changes every year. We do need to be updated on tax returns, the amount of income, what's being withheld. Make sure we understand where assets are, what your RMD, QCDs, all those fancy talks, so we can make sure we get everything ready as we prepare for retirement or help you throughout those retirement years get the most income that you need. Akers Financial Group, we specialize in financial planning and implementing each and every aspect of this. We value your trust. We want to be the person that you can trust, someone that's going to be there to help you during the good days and during the bad days. The purpose of this market update and review is to give you the information that we're using to make portfolio changes this coming year. Akers Financial Group is set up as a company where we have a bunch of advisors. At Akers Financial Group, we have 6 advisors that help me. These are our teams of advisors that help us manage money for our clients. Akers Financial is very blessed to be managing over $575 million in different ways for our clients. It's been a company that I've grown since 19 years old. It was my first time in the financial services business, and been very blessed to watch that grow over the time. What we want to do is really talk about a lot of things today. We have Akers Financial Group is set up on They're fee and commission only investment company. Fee and or commission, what we mean by that is financial fees for financial planning, fees for investment advice. When we do that, that's through our RIA, Arcadius Wealth. Arcadius Wealth. We use Brookstone Capital Management out of Chicago as our third-party money manager to manage money for us. Our AFG portfolios are through Brookstone Capital Management. They do the trading and portfolio management for us there. AFG Select, Alex Monk will be here to go over that. Mark DiOrio, which runs all the other portfolios at Brookstone, including some exchange traded funds at Brookstone. He'll be on to cover the markets in good detail. All right, there's a lot to go on going on today. We do look forward to seeing you throughout the year. We believe that annual reviews are very, very important. Being prepared for them and getting us information is very helpful. Be sure you're up to date and you know what's going on. We look forward to seeing you during the tax season and throughout the year. All right, so get yourself ready for Alex Monk as he comes and goes over the AFG Select portfolio models.
Hello, my name is Alex Monk. I'm a certified financial planner here at Akers Financial Group, and I'm co-chair of the investment committee here and wanted to spend some time as we review the state of the markets and what happened in 2025 to review our Akers Financial Group select models, or as we call them, AFG select models. So as we'll get into in the presentation, it's been an interesting time in the market, a lot of things happening, a lot of uh, new things happening on a global scale. So how do we prepare for that? Our answer is diversification, and this year it has served us well. Um, of our AFG Select models, we have four different portfolios, starting with the income model. This year, it had a total return of 8.6. It is geared for current income with a little bit of growth. So we were able to achieve our yield there. Some of the high income space and some of the BDC space that we owned to generate income had some price fluctuations towards the end of the year as interest rates change, but overall portfolio is very healthy, still cranking out strong income. From there, we go to our moderate model, which had a great year as well. It had 20.92% returns for 2025. Earlier in the year, we lifted some of our defensive hedges and shifted to more equal weight while maintaining our exposure to gold and commodities, and that has served us well. From there is the moderate aggressive model, which takes a little bit higher risk aspects just through concentration. It had a year-to-date return for 2025 of 20.32%, having some of the pullback towards the last month of the year coming from the overweight in that portfolio to the tech sector, giving the moderate portfolio the win for the year between the two of those. And then from there, we have our diversifier model, which has gotten a lot of attention this year because gold is now shinier than it's ever been. Same with silver. So our diversifier model had a 38.11% return for the year of 2025, largely due to our concentration in gold, silver, with some other alternative assets. With the theory being pairing that portfolio as a way to diversify overall portfolios in conjunction with our moderate or moderate aggressive model to get our core allocation, our well-diversified portfolio that's going to be there to deliver returns through market cycles that are unknown and unprecedented times. These returns are available to anyone that wanted to see more. Just please reach out. Let us know. We're always happy to review how this impacts you one-on-one. And we're looking forward to a great 2026 and not reinventing the wheel. We're going to stick to our core of diversification, quality assets, and taking risks where needed while protecting from downside and hedging for inflation. And that's going to be a bigger deal than ever. Thanks for joining us. We look forward to working with you in the future.
Hello, it's Brian Akers, and here with me today is Mark DiOrio. Mark DiOrio is our Chief Investment Officer of Brookstone Capital Management out of Chicago. Akers Financial Group works along with Brookstone to manage money through our Charles Schwab accounts. And Mark DiOrio is a portfolio manager for many of the portfolios that we have. So, Mark DiOrio, we welcome you to today. How are you doing?
Great. Great to be here. Thanks, Brian.
So, you've been with Brookstone about 11 years?
I have. Yeah, it's been
Uh,
quite a run.
yeah. And how much money is Brookstone currently managing now?
Just over 13 billion. So when I got here, we had
Wow.
just over 1 billion. So as I
Wow.
said, it's been a fun ride for sure. And we've seen a lot of different markets over the last 10 plus years.
Absolutely. And so, what we want to do is hear about 2025 and talk a little bit about 2026. And then I look forward to asking you some questions after you give us the state of the market. So, Mark, give us your presentation on the state of the market.
Great, sounds good. Well, what I put together, Brian, was about 20 slides to really go over the market. So I'm not going to dwell, just in the sake of time, not going to dwell on any one slide per se, but I am going to go through the different slides because I think there's good points in there. In Brookstone, you see this little 20 logo at the top here. So 20 years Brookstone has been around. So we're pretty proud of that around here for sure. So number one, year in review. This is the S&P 500. The blue line there is the S&P 500. The red line is the S&P 500 without the Mag 7 stocks. So these are really the seven largest stocks in the marketplace. So generally tech related, if you think of Apple and Microsoft and Google and Meta and Nvidia and so forth, and Amazon. The green line are those Mag 7 stocks. So really, we had a pretty major sell-off starting in mid-February, and that was led by the Mag 7 stocks. They were down about 25%. So these are the darlings of the market. Together, they represent almost 40% of the entire S&P 500 index. So the index is very concentrated today in those large cap tech-related stocks. But if you look at in the red line there, uh, all the other stocks in the index really sold off very mildly and came back within 30 days, essentially. They didn't go negative for the year until April and then bounced back all the way back to even by the end of April, where it took the Mag 7 from mid February all the way into June. So that was a pretty major correction for those stocks. And then they led the way the second half of the year as well and led the rally. But it wasn't really broad based in terms of the overall rally, which I'll get into in a moment. So that was a pretty good look at how the market shaped up and really setting the tone. Of course, the market was supported by interest rate cuts. So there's a 9 month pause. And then the Fed uh, cut rates three times last year. So that was widely anticipated that they were going to reduce rates. And what the Fed, what interest rate we're talking about here is short term rates. And so that's been reduced into about the mid 3% range. And there is some expectations as we go into this year that there'll be two interest rate cuts, and those really won't happen till mid-year. And so the market is usually supported by interest rate cuts, so that's usually supportive. And where you see this big stair step upward into 2022, that's actually a headwind for both stocks and bonds, and that was a big bear market year for stocks and bonds that year. Bond prices are inversely correlated to interest rates, so as interest rates rise, bond prices decline, and that's why you get that scenario, and then vice versa. Even though the market is kind of dominated by these large cap tech stocks, earnings have been very good. So all the way to the right, you can see the orange bar is really the percentage of stocks that are reporting earnings that are outpacing consensus. So this is pretty high. It goes back to this is one of the highest over the last 25 years, basically, in terms of the percent of stocks outperforming. So it really has been an earnings driven bull market. Earnings have been very strong throughout. So despite some of the headwinds that you may hear about, earnings have stayed very stable and then continued to grow and surprise upward. Even though you had the majority of stocks showing a positive trend in earnings, this is a very interesting chart to me that tells really the last couple of years. On average, you get about almost 50% of stocks outperform the S&P 500, 50% underperform the S&P 500 in any one given year and give or take. Well, in the last 3 years, it's been an ultra low number of stocks outperforming the S&P 500. So less than 30% of stocks. So you may say, well, I have some stocks, they haven't actually been performing that well, even though the index looks good. Well, it's because the index is dominated by those mega cap tech related stocks. And so that may be masking some of what's happening underneath the surface and to the rest of the market. So there's a good and bad side to this, which is the bad side is it was a little bit of a struggle because those big cap stocks were sucking all the air out of the room. But now you have this situation where, well, a lot of stocks didn't participate fully in the rally, which is leaving them somewhat undervalued relative to the rest of the market, which could actually perform, those stocks that left out actually could perform pretty well going forward, even if those big cap techs start to stumble at some point here. And this leaves the market stretched where you have that concentration of tech related growth names. So on the bottom clip here in light blue, and I know this is hard to see, but the dash line is the average allocation. The blue is growth related, consumer discretionary, communication services, and tech. That's showing it's about double its average, or at least pretty close to 80% of its average allocation. Where you have the value sectors in orange and dark blue there, the top two clips are well below their average allocations or size in the market. So a lot of stocks have been out of favor. The energy names, even the financials, which have held up, consumer staples, healthcare. So these are pretty extremes where you could see that type of reversal happen where the rest of the market actually catches up. What's been driving the big cap tech thesis is what really now they're going by the name hyperscalers. So these are the large cap tech stocks spending a lot of money to build out the AI future and the AI infrastructure necessary. So I've seen some estimates, and I kept seeing these estimates that, oh, maybe 100 billion will be spent or 200 billion will be spent on artificial intelligence and the build out thereof. Well, those numbers seem so low to me that they weren't realistic. Finally, we're starting to see real numbers where they get into the 3 trillion to 5 trillion range for the rest of the decade. So this spending is real. It's committed money. It's a multi-year cycle. And this chart, the top dark blue lines are the cash flow of really just four big cap tech stocks, Microsoft, Amazon, Google, Meta. And then it's broken down into how they're spending that. And you can see the orange bar there, which is really the investment in AI. And that's really driven. So the last quarter, it was 400 billion spent by these four companies alone. So that goes to tell you that the numbers were way off in terms of way too conservative how much money is being spent. So these companies are actually spending down their cash hoards quite a bit in this race. And I expect that to continue. And what are they building on? So artificial intelligence, there's essentially a new infrastructure being built. And so this is multi-year, and this chart really shows the layers. So the top layer is AI and the applications thereof. The second layer shows maybe the data centers, cloud computing, cybersecurity. Then it goes down into the power base. And then before that, some of the raw materials. So you see silver, copper, uranium, lithium in there, the rare earths. And so you see somewhat of a run there. Silver has had a pretty big run as well. So these are all things definitely in demand, and it's a global competition for these. The U.S. is definitely leading the way aggressively, but these are the layers of this industrial AI industrial revolution. And so what do you need when we're talking about artificial intelligence? What are you actually building out? Well, you need three things: semiconductors. So semiconductors process and store data. So those are those chips that you talk about. They're in your computers, they're in cell phones, but they're in a much wider array of applications than you realize. Really, the modern economy runs on semiconductors. So if you remember those, the picture during COVID of cars sitting in parking lots because they couldn't move them. Well, it wasn't oil they were waiting for. It was semiconductors. And so the average new car today uses 1,500 semiconductors, 1500. So it's a big number. You need a lot of semiconductors. So they're in just about every major, even consumer electronic products, but industrial applications that you need to power today's modern economy. And for AI, you needed the most powerful chips that could process the most amount of data, because what you're doing is really trying to run statistical inferences on data. And so most of the hyperscalers have a lot of data that they can iterate on, but you need some chips to process that. Well, the largest company in the world or in the U.S. stock market is NVIDIA. Funny name, NVIDIA is the leader in AI chips. They're not the only one, but they really have benefited. So they've been the leader, and they've grown to now be the single largest stock in the S&P 500 since IBM 50 years ago. So NVIDIA, one stock represents 8% of the entire S&P 500. So you're talking about a four trillion plus market cap company. So it's currently the largest, but this is pretty historic in terms of the rise thereof. And that goes to tell you how important semiconductors are. So that was a race. Second thing you need is data centers. So the data center build out is going on all over the US. We can go pretty much into any major area and you'll see I could pull up a map of data centers either going on or flipping towards AI. And so data center built, and you can see this line really pick up in terms of the construction needed late 2022 when ChatGPT was announced. And then there's been a number of AI applications or other LLM type models that have come online. So this is moving very fast. This is a lot of money. So if you look at it and you'd say, well, for a number of years, there's a lot of spending on office buildings and so forth, and for the service sector. Well, this is being eclipsed by the AI numbers. So any downward side on office spending or any weakness in the consumer spending has actually been picked up by the spending for data centers and this build out in AI. So this is a pretty big jump. And there's about 700 data centers or so kind of that have come online in the last 2 years. So it continues to grow for sure. And you're talking about billions of dollars when you're talking about a data center and a build out. So this is not a small undertaking at all. This is several billion dollars to just build out a facility. And the third thing is power to run the chips and have the chips move and the servers. You need electricity and a lot of power. So for a number of years, we've had really flat demand in terms of electricity use. This is going to rise very quickly. And looking at some of the numbers, you're talking about some of these big data centers are going to use enough energy that basically could support 200,000 homes. I've seen estimates of 500,000 homes. So these are major power use cases. And so you may see some changes in the electricity bill. You'll see some talking about that. Now, there will be, and I expect more and more so, and there has been in some of the local markets. You can probably read about them when they talk about it, but some pushback into, well, how are all these data centers going to use some of these natural resources, whether it's the water for cooling and what demands that puts on the municipality, or electricity as well. So those are the major three things for AI and that build up. But this is continuing, and you can see these projections. This is a multi-year phase. This is not going away. This is underneath the economy, and this is why the economy and the markets have kind of ignored any other noise. This supersedes, and this is a secular growth story, and it supersedes any of the nuances or kind of the headline risk that pops up from day to day, week to week. However, this is an interesting chart. We have not been in a recession. We had a mild one during COVID, but consumer sentiment is as low as it gets in the last 45 years. So consumers have actually been quite dour, and numbers you wouldn't see unless we were in a recession. But I think they felt left out of this AI spending, and this is a different world type idea. So consumers are really down. Now, I use sentiment as a contrary indicator. So in this case, it suggests, well, wait a minute, maybe things aren't as bad for the consumer as you realize. And likewise, they're not as good as you realize as well. But it can work as a contrary indicator for sure. So I think the consumer actually might have some positive surprises in store for 2026. The reason consumers, of course, I think, feel bad, as well as somewhat being left out on this AI rush because it's kind of unclear what that future looks like, and there's a huge spending amount in there. Uh, the fact is, prices have risen. Everybody knows this, but it's pretty big if you look at the price. This is just the price increase, not the inflation rate. This is the price increases since the pandemic. So across the board, you see major new price levels. So the market found a new price level here, and it's definitely elevated. And I think that takes time to digest. Everyone get around to the new price levels. And in fact, on inflation, which measures the year-over-year growth in prices, our estimate on the left-hand side, one of the ones that we use, actually shows very benign inflation. It's under control in that 2 to 3% range, which is pretty manageable. To the right, the only number, if you look at goods, labor, housing, monetary conditions, is inflation expectations. So it's just the consumer still feeling those effects of the rising prices. So all the other inputs to that model actually are showing that inflation is pretty well contained. And so the consumer could be surprised that it's not as bad, or the price, maybe you have a pause in those prices. Another benefit for the consumer has been that oil prices have come down quite a bit. So even though we have a different geopolitical world out there, oil prices have been very muted and have come down quite a bit. There was fears a few years ago when oil was 100, and some geopolitical risks with Russia. But today it's below 60. It's in the $50 barrel range. And the other point is, on this chart, which is usually supply and demand are right in line, all the way to the right, the top clip you might see, or even the bottom, it highlights it, that we have more supply, and we've just had a rush of supply come into the market. So that's a good thing in terms of this on the supply side, but that has kept oil prices down and been supportive of the consumer. And speaking of the consumer, although they feel bad, I usually go by this rule, which is never count out the US consumer. They will spend. And on the top clip on the left-hand side, it basically tells you that consumer spending has been essentially right in line with the 20-year average. So we haven't seen really a big taper off in consumer spending. And the lower right is an important one, which is household debt service ratio. It's still well below the 20-year average. So it's nothing like kind of an '08 environment where you had leveraged banks, leveraged consumers. You have both banks and consumers very unleveraged in today's world. And so the consumer balance sheet looks pretty good. Now, some of those sentiment numbers may say, well, there's a K-shaped economy that you may hear about, which is, well, those that own stocks have done well, so their debt to assets look pretty good, and maybe they've been in their house longer, so a little bit of a kind of a demographic issue. And then those at the bottom end haven't participated on the stock market side, and they're not feeling it; they're just feeling the costs. That's true, but if you're talking about the market cares about macro data in this sense, and it would say overall debt service ratio very low. Consumers are actually in a better spot than they realize that they are. Speaking of sentiment, and we use it as a contrary indicator, as I mentioned, the sentiment on stocks is a mirror image from the consumer as a sentiment on the economy or their own consumer spending expectations. Their sentiment on stocks is actually very optimistic, more optimistic than it's been in the last 40 years. So you're hitting levels where you'd say, oh, well, maybe it's a little too optimistic, and the market now is susceptible to downside surprises. And it doesn't mean it has to be a bad downside. It may be that, okay, earnings aren't growing as fast as we expected, or there's some challenges that we didn't think about. One of those could be with the data centers. Well, that's all great that you have all these things planned, but you have to go through and work with municipalities. You have to find the energy to make sure there's enough there to service both the new data center and consumers without really prices having too much of an impact to the consumer, and so forth. So you could, and building permits and things like that as these buildings continue to get larger and larger. So that could hit somewhat of a pause. That doesn't necessarily mean it will stop it. But anyway, the market is in an environment where it could be susceptible to some of those pauses. And this is one of those ideas where it's, well, the market usually climbs a wall of worry, and now with less worry, maybe maybe we see some more challenges in 2026 than we did the last couple of years. The other positive, which I think might surprise some people, and I know it did me as I've been following this for several months, which is foreign investors have been very aggressive buying U.S. assets. So this is flows into U.S. equities, but they've been buying U.S. equities, U.S. bonds all over. So this is about $1 trillion clip that they've put into the stock market. So into the U.S. market. So you'd say, who was the marginal buyer of stocks? Well, it was definitely foreign investors. So that just tells you really that foreign investors still find the U.S. the most investable place by far. And you can see these numbers are well ahead of where they were at any time during the last 20 years. The challenge for the market will be, well, I wouldn't expect it to go at that rapid of a clip for sure in 2026. So you don't have that tailwind supporting you. And part of that is because the dollar has declined. The top clip is the dollar declining. This, when I say the dollar declines, that's relative. It could be relative to assets. It could be relative to goods. But in this case, it's relative to other foreign currencies. So the dollar freely floats. And people think of, it's expensive or it's cheap or other currencies are. So this is really the dollar relative to other currencies. We came into 2025 with the dollar on a purchasing power parity basis very overvalued. We thought it was susceptible to some natural decline. So this isn't a collapse. It freely floats against the euro and the yen and so forth. And so it's just coming down as it should. And the bottom clip there is the inverse essentially of the dollar chart, which is the one big beneficiary is gold. And so gold has rallied as well. And part of that has to do with foreign investors or foreign central banks buying gold as part of their own strategy and their own reserve asset. Being a neutral reserve asset, they'd want to take gold. So that makes entire sense. And there's an idea that foreign investors have been selling treasuries. That's not really true. They just haven't bought as they haven't been growing their holdings, but they continue to buy U.S. treasuries for sure. And they've just added gold, and gold's been a beneficiary of that because the dollar, along with the dollar coming down. So it's looked attractive from that standpoint. The length of the cyclical bull market off the lows in late 2022 in green there relative to many other cyclical bull markets. The black there is the average. So this cyclical bull has gone on longer than the average, which should tell us that, well, we're a little bit long in this run. So we want to be somewhat cautious in terms of how the market's going to respond, given the length of the bull market. And now maybe some of the good news is already baked into some of the stocks. So we want to definitely make sure we're being mindful when we build our portfolios and think about risk and making sure we've matched the investor with their risk profile. And this is our cycle composite, which gives us, it uses the 1, 4, and 10-year cycle, which tells us that, well, 2026, we have a midterm election year. Historically, the second year of the presidential cycle has been the weakest of the 4-year cycle. So the third year is usually the best. And what it does show is maybe you get some rallying into the first part of the year, continuation from the previous year. But then at some point you hit maybe a topping or exhaustion point, and then you have a decline into about the election period, or at least some consolidation. So trend is more important than level in this type of chart. So it does tell you that you could get, a 6-month type of sideways type action, maybe some downward, but no relief until about the election time. And then the market turns at that point and starts a rally that continues well into the third year of the presidential cycle, or 2027 in this case. So I wouldn't get all too worked up about how the market reacts during this year. It's very normal in a midterm election year to have some sideways action, downward action, but then it turned quickly. And you can see on this chart that when the market turns, and this gets lost, I think, on some investors, even though all the news is bad and you think it's going down, when the market turns, it turns very quick and it recovers a lot of that downside in a very quick manner. So even though nothing maybe got cured in 6 months, the market has just turned a page and is looking forward to something different, maybe 6 months ahead. And prices were then low enough or had been in consolidation phase for enough time that now the market can turn and move forward. So this is our general working thesis, at least roadmap, and we'll look for deviations thereof to this. But this is a pretty good guide and a reminder to be thoughtful with the allocations, but also not lose sight of the longer term picture that the markets do. Even if you get into a challenge, the market does turn and reward those investors for looking further down the road. So those are my 20 charts. And Brian, I'm going to bring you back in here if that's all right.
Sounds good. All right. So when I hear the state of the markets, it sounds like everything's really in good shape. And it looks pretty good on the outlook, except for a possible downturn this fall heading into the elections. But lower interest rates are good things. And a lot of this sounds like good stock market information.
Yeah, and I think you see good GDP numbers or economic growth numbers, which surprises everybody because some of the news is bad, but the news, is always the news.
Right.
And the market is looking beyond that and saying we have secular movements here underneath the surface with this big AI build out, where you'd say, well, is it just a short term? Well, it's not when you're talking about building these structures to house and to work. At some point, you get overbuilding, just like any type of building, but that's probably down the road a bit. And then you have an adjustment phase. So right now, I think this is definitely, you don't want to take your eye off the ball of what's actually moving the economy from a market standpoint. You can always massage different things and, equalizing the economy overall, but that's not what we're doing. We're trying to look at the markets and how to allocate assets.
Do you think diversification is going to work even better in 2026?
I do. I think because of that concentration, you saw only 30 stocks outperformed. I do think, and the amount of money that the hyperscalers are spending, that doesn't necessarily go to shareholders, where some of their plans previously have kind of gone into buyback stock and things like that.
Right.
Here, they're spending money because they're building out. So that's not necessarily a shareholder kind of approach. And when they're spending money, other stocks are going to benefit, but other asset classes will too. Small caps have underperformed for a long time. International, surprisingly, even though international investors are invested in the U.S., has actually perked up a bit and started to participate. They've sat out a lot of the tech movement and for years have been underperforming. So that component and dividend payers are counter-cyclical. So if you get some challenges here, I would expect that performance to pick up as well. So it's actually more of an exciting time for a diversified portfolio, because there's times when diversified portfolio would say, "Oh, I should just be in that," but you could say that every year. It wasn't too long ago where Beyond Meat was the best performing stock, and and Peloton was, and so these days. So there's always those anomalies in the market that you wish you were just there, what have you. But that's not really a durable, thoughtful portfolio.
Yeah. So, Mark, I appreciate the opportunity to have you on to talk to our clients about the state of the market and the way 2025 is and where we stand right now. As we look to the future, people always have to invest based on goals and their own personal objectives. What's great about having Brookstone and Mark DiOrio, they help lead us with our portfolio management styles. We really thank you a lot, Mark, for opportunity to work with you at Brookstone. Also, thank you for opportunity to have you here with our clients today. Thanks very much, Mark.
Thanks, Brian.
Welcome back. I hope you enjoyed Alex Monk and Mark DiOrio and our talks together about the markets, what's going on. The hard part about investing is we got to design portfolios that's for you. And then we take that portfolio, then we actually buy the investments, we manage the money, we build our protected pieces and our at-risk pieces, and a combination of AFG Select and Brookstone models. Mark DiOrio has done a great job over the years, and so has AFG Select with our investment committee. Bernie McVeigh, Alex Monk, and myself, and the rest of the advisors are on that committee. We meet every Monday as we design portfolios. 2026 is going to be a good year, a really good year, and we look forward to helping you achieve all your goals. We do want you to win in retirement, and that's why we have a radio show, Winning in Retirement. We have that also tied to podcasts where you can listen to our shows anytime to catch up on topics and information. It's a great way to keep up with everything going on at Acres Financial and also see what applies to you and your family situation. You can go to our radio podcast through our website, akersfinancial.com, hit the radio podcast, and you'll see the choices right there to pick up and listen to the radio show, the podcasts. The radio shows are live on the radio on 105.7 The Fan at 11 a.m. on Saturday, on 680 a.m. at 680 a.m. at 10 a.m. on Saturdays is the AM channel. 680 a.m. WCBM is on at 9 a.m. on Sundays for those that have time to listen for that. We do thank you for everything. We want you to have your calendar marked for September 11th for our training day. We're going to call it the Acres Financial Forum. Our idea is to give out great financial information. We'll have a lot of things going on that day. We look forward to seeing you then at September 11th around 1 o'clock to about 6:30. Sign up for our weekly email and stay tuned to everything we have going on. We look forward to meeting you and helping you achieve your goals. Thank you very much. We look forward to celebrating 20 years of Acres Financial with you throughout the year.